Here we are. Happy Independence Day. This is going to be a daily chart, MMTs. And what we're going to be looking at here as we start this is that we had this 1, 2, 3, 4, 5 day rally. But look at all the down days that we had when we were calling shorts way up here on the S&P. It's nice to know that in the shorter term cycles here, the shorter term cycles is we're hitting extreme overbought levels. So I'm going to show here very quickly that down here, that when we were putting the bottoms in, and here's the key, using the daily now. This is where we said we put in a bottom, that 200-day moving average, at 11.13% DS, oversold, okay? And that the bear was going to have an extreme problem, as they did. And that summer rallies start, and we had this a month ago. We had this 4 days up. We came right up here, but we tested the rising 200-day moving average at the time. Now, my point is 11.13%. When we got over here, we had gone from that low extreme where we said, hey, wait a minute, that's it for the bears, and then we came down and we had a test. But here's the trick, MMGs. When we were testing this before the rally, we were 11% over here oversold. But when it started to actually take off in the nice 5-day big up rally, it was building momentum to 44%, where the actual breakout occurred. Yes, you were oversold at 11%, but the breakout of the readings occurred right there. Now, when we take a look at the topper end of this resistance level using a daily, this little blue bar here, this is called a MACD, MMTs, and this is all public stuff, how the public makes decisions, and hedge fund managers and money managers, they have a little bit of someone that tells them, well, this was the place to buy down here, as it was. And my point of it is, when that pops up, it's going to create what they call, in their terms, a daily buy signal on the daily chart. And that we have come, this is the pendulum down here. This is the amount of the downsize to the bottom, and then our big summer rally going into the earnings season. So on this particular chart now, we're going to be very mindful that we're going to, in a very short term now, that these bull rallies, which are good, but when they go straight up like that, you've got to pull back, and you have to set up a base. So this is the initial breakout, but we're overbought, and this number at 86.98 could go to higher levels somewhere in, let's say 93 or 94. Now, when we take a look at the monthly level, even when we were pulling back, we remain extremely overbought here, because we do. At 91% DS on a monthly chart, that means that any movements up to test any double tops is the failure. It's been a nice 2-year trend, but look at what's below the market. Look at what's below the market on the monthly chart. Look what's above it. So it's going to take a whole lot of earnings to break this up here. But my point of it is, the higher that we go on the counter rally, and we come up, and when we start testing these monthly tops, is that we're going to be so overbought that we're going to be selling short into it. Because the problem that the bull will face for the longer term is that, and on this monthly level, I mean, anything above 90 on a monthly, I mean, we've been overbought. Anything over 80 is overbought in standard terms. But we had 1, 2, 3, 4, 5, 6, 7 months of being overbought. Yeah, we had a nice correction, had a great short. Now, on the weekly chart, if you take a look at the S&P, on a weekly level versus that monthly and that daily level, is this is the amount of down weeks, and I'm going to draw a trend line here, but I'm going to let you see it. This top, when we get there, it's going to take a lot to get that through that top up there, meaning that we went up in that 5-day period off of these bottoms, which is great. And this is the actual volatility hook. So when we had these other corrections, we made new highs. And this time, though, it's going to take a lot more to make a new high on the S&P. 1370 is where we called the correction. And now, granted that when you take a look at the standard reading here, you're at 43% DS here. So you're not over here when we called the correction, we were at 83% DS. The breakout here above the 10-week and the 20-week, as we go up, the resistance levels are going to become more resistance levels. It's going to take a lot of buyers. It's going to take a lot of people wanting to really get engaged, and they're going to have to really believe in order to break this high, this trend line, these last highs, is they're going to have to really believe that the second half quarter is the second half of the year, which we're in right now. This big weekly breakout is everything that we said was going to happen. How far it would go would be that it would have to close above the 10-week and the 20-week now. And it did. We're above it. Now, what will end up happening is, as we approach these resistance levels on the S&P, and we'll use our platform to get the numbers, is we're going to have to deal with the earnings season. The longer-term structure on the S&P is overbought. We know that by looking at the monthly chart. We know that short-term bear cycles and bull cycles have a specific pattern. And what we have had here is a weekly bull breakout at the end of the quarter, and you know, with the 4th of July holiday that we're here. But I will tell you that this is going to have to close. This S&P 500 is going to have to close above that blue line right here. That's the one that went down and it crossed over slightly, and that's a bearish tone. The thing about it is, it will take 4 consecutive weeks in a row that this will have to close above, and let's call what this is. This is the 10-week and the 20-week. And here's a horizontal trend line right here. This is where we had major support when we made off of these highs over here on that weekly, when we got that big reversal in the S&P. We called that perfectly. We also called the bottom perfectly. Short term. This is just short term. And that the bear was going to get mutilated if he didn't come out of the shorts. And that's a perfect time to always get net long and take advantage of these market cycles, where that's what we do on a daily compounded basis. My point of it is that you're going to have to close above the S&P. We'll have to have a closing weekly level 4 weeks in a row above the 10-week moving average. That's the blue line. You can't, if we come back down and we go below it and it becomes resistance after this big move, big weekly bull breakout, if we come back below it and stay below it, then, and that becomes new resistance, the bull will have a problem, and the bear will reemerge after this big weekly breakout. The bear side of the market, the bears are going to come back in. Here's that trend line right here, and it comes right up here to this double weekly top with the distribution, weekly distribution. This is what we're going to be looking for as we move into Tuesday after Independence Day is over. It's going to have a weekly distribution bar next to it. In your platform, it's going to be the key area of 1300, but it's below the 10-week moving average, meaning you can come down. So the first key area of support on the pullback, S&P, let's see where it closed. S&P 500 closes at 1339. what's going to happen is that the weekly moving averages, the pullback to the 10-week moving average. So let's find out where the 10-week moving average is. Okay? The 10-week moving average is going to be down here. And it's going to be exactly the numbers that you're going to want are going to be, let's open this up, 1315.67. So we are about, do the math, 1339 on the weekly close, up 19 handles on the S&P. Great bull breakout, lots of buyers, lots of short squeezes coming in, lots of electronic stock market orders as fueled it. So you had buyers in there, you had the stock market orders on the short sellers getting triggered out, and you have this huge, great weekly move. But my point of it is, to teach you this, is that you have to close 4 weeks above 1315.67 on the weekly in that format. Because where the real weakness was is when you broke below it, the whole trend broke below the 10-week, and that 10-week moving average was descending in value, and that's where we had the last, this was a 4-week drop that you guys went through. You were here for this part of it. And you were here, so you were selling short stocks every single day on the intraday highs, and they would roll over. Now, when the bull came in, stocks would hit the bottom and bounce just the very opposite for the bull entry. That's a long entry. And they would bounce off support and continue going up. And that's exactly what happened. Now, one thing I want to say, that moving forward in the earnings season, if the S&P 500 does not deliver good quarterly earnings across the board, that means that people are going to be selling into it. The belief is that the country, that the United States, hold on. So what I want you to know is that the belief is that the earnings, which we're going to go into the July period, is that the S&P 500 earnings are, in my view, at a very high trough level. Okay? And we've had a slowdown around the world. So if growth is going to be between 1.8% and 2.5% GDP growth, then that means that when you calculate the 500 companies in the S&P 500, that it will, as we move higher, that what I'm trying to tell you, MMTs, is that the earnings are being priced in a good scenario for the upcoming report with this last week's buying, okay, as far as that goes. And we are short term on the daily chart. Once again, we are overbought on the daily chart. So, because we went straight up, we got extremely oversold in the cycle, which was great to go long, as we said. The selling was going to be over. The thing that I do want to emphasize on, they had priced in a slower economy in the U.S. in this particular cycle when we went down about 100 points in the S&P here now. Okay, that's the mathematical reversal, a little over 100 points here. Now, when I take a look over here, and I take the low of the S&P, and this is what I'm talking about. When it didn't want to break that 1263, that low was 1267 on the S&P. And the high on the S&P was 1341. That's the amount of volatility upside. When we were over here at the correction, the high was 1370, and this low over here was 1258.07. And that's exactly where the other corrections, and they came in, they rallied up, but then they came back. See, this last counter rally from here to here, it failed and it came back, and now this is that big counter rally, but it's all done in a 5-day period. Good for the bull side. However, when things go up too quickly and too rapidly, when we were coming down, we didn't go down that hard. But we have taken out all of this selling pressure in this whole 4-week area to the upside. I'm saying that the earnings are priced to perfection as we go into the earnings. And that there is a time where the market was pricing in a short term now, very short term level, was all of the contagion, QE2 coming off, Bernanke doing what he's doing, Obama administration, this and that, debt ceilings, Greece, all of that is all in here. So what I'm going to be cautioning people is that when it's all about buy the rumor, buy the oversold market, when we get into the S&P earnings, sell the news. So our whole plan is that when certain leadership stocks in the S&P 500 gap up on a quick earnings report, it's already going to be priced to perfection, and we will be selling short into that good report, because that means that understanding how markets have pricing and discounts to trends, and discounting the news, discounting bad news. But look, this is all great news. No one says it isn't. We were in on the bull side of this, and this was a great way to be. We're also on the bear side. So what I'm saying is, buy the rumor, sell the news. The thing of it is, next Tuesday, it's going to take a lot of buying. End of the quarter buying is over. We're in the second half of the year where the bull mentality, they really believe that we're going to have 4% GDP growth by the end of 2011 calendar and by the end of the year. I don't see that being the case right now, because there's lots of economic things that have a big overhang. It's going to take a lot for this administration in Washington, D.C. to make the changes to break these tops. We are short-term overbought. Any movements up in individual equities starting next Tuesday, we'll take a look at them separately. And the leadership in the S&P 500 stocks, the leader stocks, will reflect the same breakout here. And they too, from short-term oversold to short-term overbought. And when we're short-term overbought, that means that the upper resistance levels must be sold short. And that is where the money will print. And what will happen is, now that the amount of bull exuberance has come back in, and it's always, which way am I going to put my trades on? Well, hey, when that exuberance is there, that's a great way to make money off of them. It's wonderful. When they're pessimistic is over here, it's a great way to get overbought over here, and it's a great way to make money selling down short. When there's pessimisticness, gloom and doom, and that they have come back. We are going to be in a very sideways market, and that the higher that we go in this bull trend back up, and it is a bull trend, it's a new bull trend that has just started because you're above the 10-week moving average. So it is a new bull trend, but let us beware that the bull trend is a short-term overbought market, and that stocks hit next week to the upper end of their price levels is to take that short because of the amount of buying, and we ran up too quick, too fast. There needs to be a consolidation, a pullback and a consolidation. So the price action volatility will remain at extremely high levels. And the July 11th earnings season, that S&P 500 companies, as we're going to be monitoring how much of the international, that's global, outside of the U.S., where those earnings are actually going to be coming in. And I'm just going to tell my MMTs now, anything that gaps up, because we're short-term overbought, when they gap up, we'll sell short those gaps on the S&P.